All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down some of the different trading strategies that you can use to trade natural gas. Now, there's many ways to trade natural gas. There's futures, there is UNG, there's boil, there's cold. But what I'm going to do is break down some different strategies along with different time frames, as time frames are pretty important to the strategies and are going to determine, a lot of times if something is a swing trade or, an intraday trade or a scalp. So make sure to smash the like button, subscribe to the channel if you're new. And the first thing that we're going to start off here is actually the spot price of natural gas. And the reason that we look at that is because obviously the ETFs or, the futures or different things like that, they are going to, reflect some of the movements of the spot price of natural gas. So if you pay close attention to it, then you can learn something and, possibly see, where things are going to be heading. So the first strategy that we're going to be going over is the daily time frame. So we're looking at the daily chart here. And we're going to go over MACD signals along with RSI divergences. Okay, so if you take a look here, we have a low and then a lower low. So, the price of natural gas is clearly going lower. Now, let's look at our RSI. Remember, this stands for Relative Strength Index. So it's going to measure the relative strength of something at its given price. So at the same point where we have a low here as well. And then we make a higher low right here, okay, higher low, but we make a lower low on the price. So in this case, that term would be bullish divergence. So we get a bullish divergence on the relative strength index for the spot price of natural gas. That's an indicator you may see some bullish activity. Now, you can never predict the amount of activity or if it comes for sure, but it is an indicator that traders like to use is bullish divergence. Now, what you can also do is combine that with the MACD. So that way, rather than just one strategy, okay, you have two strategies combining together for an entry or an exit. So in this case, we're going to look at the MACD, and what we can see is it crosses over right here, this red line, and then it comes back down and crosses over again. When you see these crossovers, that's typically what would be known as an exit or exit or entry signal. So in this case, the red line going above the blue line is going to be an entry signal. And if you take a look, there's even a bullish divergence along the MACD as well, right? We can draw one here like this, where the price is going lower, right? But we're seeing higher lows on the MACD. So the MACD or the RSI is not the only thing that can have divergences. You can definitely use the MACD as well and try to combine some of those things together. Now, if you take a look at the price action shortly afterwards, we get a nice move to the upside, and it's up to you to determine what your profit goals are after you get the activity that you were looking for. Over here, we have the exact opposite of a bullish divergence. We have bearish divergence. So we have a high, and then we have a higher high right here. Then we have a high on our relative strength index, followed by a lower high on the relative strength index. So in this case, when your RSI is making lower highs and the price is making higher highs, that's going to be a bearish divergence, right? So we get the bearish divergence, and right around the same time, we get an exit signal on the MACD, and we see it going down, right? So what you could do is you could potentially get in some short plays, okay, like KOLD. You could get into put options on UNG. You could get into put options on boil. Things like that. Those are going to be some different strategies that you can look into for, exit signals. All right. Now, this plays out multiple times throughout the chart. Okay. We see it over here, higher highs, followed by lower highs on the RSI, followed by a MACD sell signal. We get low, lower low. We get low, higher low, and then we get a crossover. And each time the divergences have played out while also giving a divergence on the RSI as well as a MACD signal. So the MACD is most effective on the daily time frame. That's why we're looking at the daily chart here. And I really like the MACD on the daily time frame. You can use it on other time frames, but it's just not always as effective on the lower time frames. So the next one that we're going to do is we're actually going to take a look at natural gas futures this time. Now, we're going to use the supply and demand zones, and we're going to combine that with the MACD and RSI signals on the 1-hour chart. So if you take a look, we have an area of demand. Now, I have a complete supply and demand tutorial on how to draw these zones, how to really understand them, what they are. A demand zone is simply an imbalance of buy orders that pushes the price up higher. And a supply zone is simply an imbalance of sell orders that pushes the price lower, meaning that there's more orders of the respective zone, whether it's demand or supply, and that increase of orders, that imbalance of orders, is ultimately what drives the price down or up, respectively. So what we do is we establish an area of demand over here, all right, and we come down and we're retesting our demand zone. Now, just because we've tested our demand zone doesn't mean we necessarily have to enter, right? One strategy alone isn't always going to give you the best edge in the market. To really have an edge, you want to combine as many strategies as you can without overwhelming yourself and without making things ridiculous. So if you notice, we have no moving averages, no VWAP on here. We just have supply and demand, and then we're using the MACD as well as the RSI. So same thing in the last one. We have a low here, we have a lower low, and then we get a low, we get a higher low, we get a bullish divergence followed by a MACD crossover, right? And what do? We ride that entry up into our previous supply zone that we established, right? We established over here, there's an imbalance of supply, pushing the price back lower. We came back into that zone, and you can comfortably take profits here, or you can set a stop loss after you come into your supply zone, however you want to do it. Or as soon as you get a nice little movement, you can just take profit along the way. But what we did here was we essentially combined three things together: one being the demand zone, two being the bullish divergence, and then three going to be the MACD sell or entry signal. Over here, we're looking at UNG now, right? We're going to combine the supply and demand zones with the 3 SMA and the 8 SMA crossover. And this is on a 5-minute chart, okay? So on the 5-minute chart, what we did was we established an area of demand right in here where we, kept bouncing up, pushing up higher, not able to reclaim our supply zone overhead. But what we do is we come back down, we retest it, all right? And we have our SMAs on here. So we have the 3 SMA here in blue, and we have the orange SMA here is going to be the 8 SMA. So when the 3 SMA crosses above the 8, right, and it goes up above, that would be kind of a bullish signal, okay? And then whenever it crosses below, that's going to be a bearish signal. So there's a couple different ways to do this and really combine this, right? You could take an entry in your supply and demand zones and then look for a crossover as confirmation, or you can, see that we come into an area of demand, see how we react to it if we get the crossover, and you can enter after the crossover on the preceding candle of the crossover. So that's up to you to decide, and then you see we come up, we enter into our supply zone, and you can enter a position, in your supply zone and set a stop loss shortly outside of your supply zone, just in case things continue to push up higher. You can manage your risk, or you can say, hey, we entered into a demand zone. We got a pretty big red candle right here, and then we got the crossover, and you can ride that momentum down into your demand zone. However you want to do it, there's multiple different strategies, multiple different ways, multiple different tickers and things you can trade. Again, we've looked at spot price, we've looked at futures, now we're looking at UNG, and we're going into smaller time frames. So, keep that in mind too. This is a much smaller time frame. This is a 5-15 minute trade before you hit your profit goals. Same thing over here. You enter after the crossover. This is 5, 10, 15, 20 minutes. And then, within 20 to 25 minutes, you come back down into your take profit zone if you were taking this position short. The next one we're going to look at is this is going to be UNG. All right, now we're actually on the daily time frame now, and what we're going to do is combine a chart pattern, because chart patterns are pretty common. A lot of people like to use chart patterns, try to draw them up. I have a whole tutorial on chart patterns as well in my free trading course playlist, where I actually go over most of these strategies that I'm going over in this video in a little bit more detail. But if we take a look, we have a rising wedge here, okay, indicated by these two trend lines, and that's a bearish chart pattern where you're going to look for a break below this trend line here and look to see, if that pattern plays out, you should get a strong move to the downside. So that's going to be our first little strategy that we're using here. As we see, we have a chart pattern developing. Number two, we see that we're getting bearish divergence again, right? We're making highs, higher highs, higher highs, right? We're clearly in an uptrend. The relative strength should reflect that, but instead we get a high, we get a lower high, and then we get a lower high again. So now we've established we have bearish divergence. We've established we have a bearish chart pattern. That's two strategies now. And then what do we get? We end up getting a MACD exit signal here where the red line crosses below the blue line. And ultimately, we get three strategies combining together, right? We had the bearish chart pattern. We got the breakdown below. Okay, then we got the sell signal on the MACD, and we also had the bearish divergence. Now, if you wanted to just be even more confident, right, you could wait for the 3-8 SMA crossover, right? So we got all of those signals, and then you get the crossover right here, and you can take that down. As you can see, we do bounce back up a little bit. So, you would have potentially gotten stopped out. A lot of times when people use this strategy, they set a stop loss or, an exit once you get the crossover back to the other side. So if you get a crossover to the downside, a lot of times people will have an exit once you get a crossover to the upside. But you can see here that doesn't happen. We come over, retest, and then we continue pushing lower. So, there's about 4 different strategies we used off of this one and off of this setup. Now, remember, no one strategy is going to be perfect. You don't have to use all of these strategies and combine them all together, especially if you're a beginner. But once you start to get a little bit more advanced and you start to, be able to recognize a lot of these signals and spot some of these plays, you can feel a little bit more confident in your play. Now, of course, this video is not financial advice. This is simply educational and informational, showing multiple different ways that you can trade natural gas, whether it's long or short. All right. Now the next one is we're going to look at BOIL, okay, which is BOIL, I know is really popular. And what we're going to do is we're going to take a look at the Fibonacci levels. Now, if you're not familiar with these, the 3 most common and well-respected retracement levels are going to be the 61.8% level, the 50% level, as well as the 38.2% level. Those are the 3 most common and well-respected Fibonacci levels. And you use these to establish if you're in trend continuation versus trend reversal, because nothing moves in a straight line down or in a straight line up. Rather, you get a move up, retracement, continuation of that trend, or you get a move down, retracement, continuation of that trend. That's how you can spot trend continuation. And that's what we got here, right? Is, we ended up getting a little ABC pattern down here, a 3-wave move. We got a move down, retracement, continuation of that trend. Now, you can spot reversals, okay, when you move down, retrace, consolidate a little, and then break through those retracement levels. So if we would have came down here and started consolidating and then broke out past the 61.8% level, flipped that to support, then we could have spotted a potential reversal where we would have made a high and then a higher high. So they're really useful. And if you're in a downtrend, it's really risky to go long in these areas here, as there's a high likelihood you're in trend continuation. Rather, if you're trying to chase, right, and you feel like you're chasing it, wait for a breakout and a retest, and then you can have a much better risk to reward ratio, right? You can enter right around the top of your 61.8% level, and you can have a stop loss at the 50% or shortly below, and then you'll be able to have a much better risk to reward ratio, as you've already gotten the breakout, and now you're just looking to see, or do we retest it and push up higher? Or if we fail the breakout, then most likely we're going to continue that trend, as you have a higher likelihood of trend continuation below that 61.8% retracement level. Now, you can also combine that with the MACD as well. Again, this is on the daily time frame, but we see we get an A down, a B wave up retracement, and we reject exactly at our 50% retracement level. And then what do we get shortly afterwards? We get a MACD sell signal where the red line crosses below the blue line. Now, if you don't know how to draw the fibs, okay, for a downtrend, what you're going to do is you're going to start at the top. So you're going to take your swing high, what they call it, and connect it to your swing low. So now you have the move down, and you're looking to measure the retracement and see whether or not it's a healthy retracement for trend continuation, or if you break through those retracement levels, again, the possibility of a reversal. Now, the next one we're going to look at is going to be the natural gas futures chart. And what we're going to do is combine a chart pattern with the Bollinger Bands. That's what these 3 sets of lines are going to be right here, the Bollinger Bands. And then we're also going to combine that with RSI divergence as well as the MACD signal. So again, multiple different strategies you can use. We've gone over moving averages, Bollinger Bands, supply and demand zones. All right, the chart pattern we have here obviously is going to be a head and shoulders. We have our left shoulder, we have our head, we have a right shoulder forming here. And then we also use the fibs as well. I've highlighted about 3 different entries that you could have had on this play. So let's go over the first one right here. So the first short position that you could have taken on this, the first indicator is we're, trading outside of these Bollinger Bands. Okay. Typically, if you take a look at the chart, the chart is not going to stay outside of the Bollinger Bands very long. They kind of act like rubber bands, and price is going to snap back in towards those Bollinger Bands. And you can see we come outside, we snap back to the middle. We come outside, we snap back to the middle. We come outside, we snap back to the middle. Okay, now there are going to be exceptions, right? Over here, you can see that we come outside and we just continue that uptrend. So, again, no one strategy is going to be perfect and it's never going to work 100% of the time. But again, you start combining a couple things together and you can have some more confidence. So we see that we're trading outside, but we don't know if we're going to do like we previously did in the past and continue an uptrend, or if we're actually going to snap back. So what we do is we take a look at our relative strength index, and what do we see? We have a bearish divergence where we have a high and then a higher high, but a high and a lower high. So now we have bearish divergence combined with trading outside of the Bollinger Bands. And then we end up getting the MACD sell signal right here where we cross down below. So we ended up getting three different things really confluence and giving a nice entry for a short position right around here. And again, you can set your own profit goals and stop loss according to your own risk management. Now over here, what we do is we start to see the chart pattern develop, because over here we just have a left shoulder and a head. We don't have a right shoulder. Okay, what we do now is we see we've come down, we've established a little bit of a neckline, and we started to bounce. So we're going to use our Fibonacci levels to determine if this is a healthy retracement for trend continuation, or if this is potentially going to be a reversal, right? So what do? We connect our swing high down to our swing low. We see we come down, we retrace up exactly to the 61.8% retracement level. We see that now we've made a right shoulder and we're starting to form a right shoulder. So we have two things kind of leading us together. And then previously we had the MACD exit signal as well as the relative strength bearish divergence. And, those kind of just give you some added support. So you can take a short position right around here, around the 61.8% level, have a stop loss wherever you feel tolerable, slightly above that level, and then look to write it down to your profit goals. And what ends up happening is we end up breaking the neckline. Okay, once we break that neckline, you see we get a breakdown, a retest. That's another opportunity for an entry. Okay, that's clean textbook break, retest, continuation. All right, and that's what you look for. That's some of the things that I've gone over in this video is looking for a break and retest rather than just entering into a trade potentially early, right? Let's say you entered into here and then you had a tight stop loss on and you got stopped out on the retest of this neckline of your head and shoulders. And ultimately you ended up getting stopped out of that play just for it to end up playing out and working out very successfully. So hopefully you enjoyed this video. If you did, smash that like button, subscribe to the channel. Let me know if you want to make another video like this. I can do this with some other strategies perhaps that I didn't include in this video. So if there's some trading strategies that you would like me to go over for natural gas, I'd be happy to do that for you. Just comment down below and I'll make a video on it as soon as I can.